I now hand the conference over to Mr. Unnatan Shekhar, Promoter and Managing.
The conference is now being recorded.
Limited. Thank you, and over to you, sir.
Thank you. A very good afternoon to all of you, ladies and gentlemen. Welcome to this conference call. Yesterday, the 8th of February, marked the third anniversary since Galaxy Surfactants got listed in 2018, and this Q3 performance adds to this momentous occasion. Before we delve on the results, I would like to take a few minutes to reflect on this journey. A journey which, though began only in 2018, has been in existence and has been created brick by brick since 1980. Steve Jobs says, if you really look closely, most overnight success took a long time. Since listing, Galaxy's consolidated profits have grown from 158 crores in FY18 to 223 crores for 9 months ended December FY21. Such has been the pace this year that we have not only grown despite the challenges, but we have nearly achieved the last year's number of 230 crores in just 9 months. While this may look like a one-off, let me assure you that this growth is sustainable growth that has been achieved on the back of sustainable volumes and margins, driven by segments, customers, and geographies. But as Steve Jobs had said, what appears as overnight success in reality is a mixture of discipline, persistence, and consistency. And this performance and consistency has been demonstrated by your company over the last 40 years. I would like especially to acknowledge my co-promoters, board members, all our employees, past and present, across all the geographies, stakeholders and well-wishers who have stood by us at all points of time and enabled us to reach this level of consistency. Moving on to our performance, if Q2 stood for recovery, the Q3 stands for normalization, sustenance, and resumption of the growth trajectory. The robust momentum of Q2 has sustained in Q3. We are pleased to share that Q3 marks the first quarter in FY21 where your company has grown in every area, be it segments, regions, or each of the financial parameters we measure ourselves on. This quarter also marks the first in financial year 21 where our specialty portfolio has registered a year-on-year growth, arresting the decline reported in the last few quarters. Demand environment continues to remain robust, thus clearly highlighting the resilience and underlying strength of your company's business model. With the vaccination drive gaining traction, opening up of the economies with greater consciousness about health and hygiene should augur well for our performance, masstige as well as premium specialty products. While demand environment continues to remain robust, rising volatility in raw material prices, supply chain disruptions pose the biggest risks in servicing this underlying demand. But despite the challenges, and none bigger than the one seen this year, we remain confident and optimistic about our growth journey. This confidence, ladies and gentlemen, emerges on account of several factors. One is our product mix, which caters to multiple categories of the home and personal care space, be it the well-established ones like toothpaste and shampoos, or the emerging ones like hand washes, premium laundry, face wash, or baby care. To elaborate, for our Q3, Our performance surfactants, which form the base of cleaning formulations, grew 4.7% and year to date have grown at 9.3% on year-on-year basis. The specialty care products, which impart functional features to the formulations, grew 12% for Q3, the first quarter of year-on-year growth in FY21, thereby arresting the decline of last few quarters. And for the 9 months ending December 20, the specialty care products stands at minus 4.4%. Secondly, our innovations, that is new products emerging from our innovation funnel, shall form the bedrock of our next decade of growth. These are products designed to cater to the emerging trends of non-toxicity, sulfate-free, green and natural solutions. Our new products in the non-toxic preservation, sulfate-free and proteins range accounted for 5% of the revenues in Q3. Our geographical spread and customer mix, which comprises of presence in over 80 plus countries, catering to multiple tiers of customers, adds to the robustness of the business model and enables risk mitigation. To elaborate, in Q3, all regions of India, the Africa, Middle East, Turkey region and the rest of the world recorded growth. India maintains its momentum from Q2 and registered a 14.4% growth in quarter 3. The YTD growth stands at 13.2%. AMED grew 2.9% in Q3. The 9-month period growth stands at 6.3%. The rest of the world, after declining for last 2 quarters, registered a growth of 4.3% driven by specialty care products. On the YTD basis, the rest of the world has declined by 10.1% in volumes. Post the lockdown, smaller businesses were most impacted. But post-June, we have seen a strong improvement in our business share with the non-MNC customers. The T1 revenue share, which stood at 63.8% in Q1, now stands at 50.4%, thus highlighting the improving share of our non-T1 customers, which has aided growth. Thus, our overall volume growth for the quarter stood at 7.3%, and for YTD, the same stands at 4.2%. The EBITDA includes export incentives realized in Egypt, accounted for on receipt basis. The net incremental export incentives included in Q3 over previous year equals to 14 crores, and adjusted for that, our EBITDA per metric ton stood at rupees 18,630 per metric ton. For the year to date, the same stands at 18,515 per metric ton. Given that we have been sustaining above the upper range of the band stated, that is 15 to 17,000 per metric ton, we would like to upgrade the band now to 16 to 18,000 per metric ton. To summarize, ladies and gentlemen, businesses that stand the test of time and persistently deliver consistent performance year on year are the businesses that last for decades. At Galaxy, our forte is consistency and persistence, and this year's performance yet again demonstrates that. Thank you, ladies and gentlemen. I would like to open the floor for questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, please press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Thank you, and thanks for providing this opportunity. So, couple of questions from my side. First, on the innovation funnel, and Shekhar sir, you did mention that in Q3, 5% of our revenue came from proteins and sulfate-free. Just wanted to understand the outlook on these new products, which includes protein, sulfate-free, mild surfactant, and phenolphthalein, which is our preservative portfolio. All put together, what is the revenue contribution as on 9 months and in next 3 to 4 years? What could be or what kind of revenue contribution are we expecting from these products plus the new product portfolio which we are seeding today? It would be great if you can give some outlook on this and the outlook on the new product portfolio seeding that we are doing today.
What I can only say is that, Sanjesh, that these specialty ingredients have performed very well and they are progressively growing. As you know, every single new product introduction, particularly with specific to a particular customer, takes a period of time in terms of testing, formulating, stability, and so on. But what is significant and important to note is that there has been a secular trend of acquiring new customers and growing, consistently. So, and as we reiterated, the growth will be on proteins, and where vegetable proteins is a forte of innovation for Galaxy. The mild surfactants in their various subdivisions, and of course the non-toxic preservatives, and of course the synthetic and transparent bathing baths, which have of late become much more prominent and gained visibility, quite a bit of visibility.
So, what is the percentage of contribution today here from all these products? I know last year we mentioned in our annual report upwards of 20% growth in a lot of these products. Do you think that kind of a growth is sustainable over the next 4 to 5 years?
Yeah, of course. These particular new products obviously are new to the industry, okay? Right. And they are driven by the consumer trends, where the consumers are seeking non-toxic products, sustainable products, natural products, vegetable products, and these products are developed to respond to these consumer needs and trends. So these products will be, the engine for growth as far as Galaxy is concerned. And as far as performance surfactants is concerned, we said the engine for growth is the evolving geographies and the emerging emerging economies like Africa, Middle East. Of course, India still continues to remain as a geography where performance surfactants will continue to grow.
Good that you touched upon performance products. I was just coming to that. And Matt, looks like the volume growth has somewhat tapered down versus what we have done in the first half.
Yeah.
So why? Because we haven't seen a lot of disruption in the Egypt, which is our key geography, and adjacent geography. It is more because of exports to Europe from Egypt, which is hurting this growth?
No, as a matter of fact, Sanjesh, you would have noted that performance surfactants grew by 9.3% in the last quarter. Okay, and for the 9-month period, they have grown by 4.2%. I'm sorry, performance surfactants grew by 4. I know it is the reverse, 4.7%, and for the entire year, but for the 9-month period, it has grown by 9.3%. See, there can be always some amount of ups and downs during this quarter, particularly because there has been a huge amount of disruption on the supply chain. So customers tend to stock in anticipation of the various disruptions that they could foresee. So what is important for us to note is the growth of the 9-month period, not a specific quarter. The specific quarter of 4.2% this year doesn't indicate any sort of decline or anything.
Particularly on AMAT, what happened to AMAT? It was 2.9% YOY growth there.
AMAT is Africa, Middle East, Turkey region. See, a large part of it is also due to the supply chain disruptions, Sanjesh. Okay. Now, given a very, very normal situation, we would have always been able to sell more.
Okay, so this is nothing to read in this 2.9%. It's more logistical and nothing to get concerned about in the AMAT region. One on the margin, now that we have upped our guidance by 1,000 rupees per metric ton, both on the lower end and on the bottom end, and our guidance that we will keep seeing this new product growth inching up. In the future, as a contribution of these new products goes up, it is fair to assume that there could be more upside in this guidance?
Yes. So there will be a progressive growth as far as EBITDA per ton is concerned, in line with the increasing, whenever there is an increased share of the specialty ingredients in our portfolio, but that will not happen in 1 or 2 years, because as we have always said, both these categories will grow.
Okay, that's fair. Just last bookkeeping question on the dividend distribution policy. Now that we have announced 14 rupees interim dividend, and we are comfortable on the net debt levels, and we don't see a large capex outflow, is there any revised thought process on the dividend distribution policy?
So actually, the dividend paid last year and current year suggests that we have been increasing the payout, right? We started with 8, last year we gave 14.
Correct.
And this year interim also we have given 14. What we generally do is that earlier we used to give 25% of the standalone profits. Now we may enlarge the base depending upon the growth required.
So have we relooked at 25% standalone profit as a dividend now that we are already now at last year's dividend in terms of interim? That means we can expect a little bit more in the final. Are we really looking at this 25% profit as a dividend? Are we looking at increasing this number?
See, the interim paid itself is 14 now.
Okay. So that's what I'm telling. Are we really looking at this policy of 25% standalone profit as a dividend? Are we planning to increase this progressively?
The CapEx plan of the coming years also, no? Depending. So generally, the preference is for growth, right? Okay, we can increase the payout depending on the growth requirements.
So what I can say, Sanjay Natarajan here, is that although our bias is towards increasing the dividend payout, but as of today, we are not revising our payout policy. Okay, so that probably should.
That answers the question. Yeah. Thanks, Ganesh. Thanks, Natarajan, and thanks, Shekhar sir, for all the answers, and best wishes.
Yeah.
Thank you. Participants, to ask a question, you may press star and 1 now. The next question is from the line of Keyur Harish Pandya from ICICI Prudential Life Insurance. Please go ahead.
Previous question forward. So if you can throw some light, what are capex plans? Looking at the demand revival, are we looking at, say, accelerated capex?
See, as you know, we had initiated a number of capex. One was a capex at Tarapur to take care of new products. The second was our expansion of R&D center in our TTC, that is in Vashi, Mumbai. The third was for my surfactants and non-toxic preservatives in Jagadia. These capexes we had initiated in FY20. They did get hindered, because of COVID, almost for about 7 to 8 months of this year. But they have started in right earnest, and we are quite optimistic that we should be able to commission them in the first quarter of the next financial year. So the capex continues to be high on our agenda. As a matter of fact, we had intended to spend about approximately 150 crore of capex in this financial year. I think we would manage to incur only about maybe 70 or 75 crores, and this will get pushed to the next year.
Okay. So all these are announced capex. Anything other than that, which is under consideration?
I'm sorry. There are also some more capexes which got initiated this year is concerned, and they are in the process of getting executed.
So what will guidance for say 22, 23, or 2 years as a block, whichever you can share?
I think approximately we may...
Under 250 crores. Earlier we mentioned what happens is that we have one or the other production line that the capacity will get utilized. And generally we have been investing around 150 crores in a year. That should continue.
Okay. So second question, as you mentioned, probably it is better to look at year-to-date numbers than say particular quarter. So when I see say performance surfactant volumes Q on Q changing or reducing, there should be, nothing to be read in that, right? Or is there any seasonality or any deceleration?
No. We should not read that because if you see, only the break can happen due to any sort of disruptions like what happened with COVID. Okay. Otherwise, the growth of performance surfactant should be secular. As you know, the growth rate in India has been around 8 to 10%. At a global level, it has been about 2 to 3% as far as the personal home care industry is concerned. So that should tell you the growth rate that this industry experiences.
Okay. Sir, last question. So when I look at the block, I'm just comparing say FY19 year-to-date numbers, basically first 3 quarters of FY19. I think we had similar mix between say specialty and performance. First 9 months of FY21. So the mix has not changed between performance and despite that per ton gross margin or as well as per ton EBITDA margin have improved both. So what has without change in mix this has happened?
Yeah, so Chetan is Natarajan here. So one is although the spread between the split between performance specialty hasn't undergone a change compared to the corresponding period last year, but what we need to understand is that within the specialty ingredients portfolio there has been a change in terms of the product categories. Okay, so we have been able to do more preservatives, we have been able to do more proteins. Okay, so that is one contributing factor. Okay, so and second, also in the performance surfactants category, we have been able to look at various opportunities where we are able to better our realization. So that's probably explains.
Okay, understood. And sir, just last question. Looking at the size of the industry which we are catering to, and our say portfolio of new say product additions. The way we have increased our guidance for EBITDA per ton, do you think is there a possibility to increase our revenue growth guidance or say that range that we generally talk about, say mid or to high single digit? Can that go up, or why we cannot grow at say double digit consistently? Just your thought on that. That is it. Thank you.
Yeah, even so, we do not hazard any guess on giving guidance on revenue growth because that's a combination of many factors like your feedstock prices and all that. So typically, what we say is that we will grow ahead of the market, okay, and that's what we have been doing in terms of volume terms. Okay, continuing to focus both on the developed and the emerging markets as well as on both the segments, both performance and specialty ingredients, and that would continue. Okay, so hazarding any guess on revenue growth, okay, is obviously not right.
No, sorry, my mistake. Basically, volume growth I meant. So pricing is a different thing. Volume growth, can we accelerate our volume growth can we accelerate the volume growth or our guidance on the volume growth, considering our size in the overall scheme of things as well as our speed of innovation?
See, if you look at our CAGR of our volume growth for the last about 5 years has been about 5 and 3 years has been about 8%, and last 10 years has been about 11%. So as we've always been saying, that I think this 8%, 5 to 8% is something that we would like to continue in terms of our guidance on volume growth. Okay, now in terms of it going in double digit, I think we'll probably come to that stage sometime later once we have.
Yeah, all of us would wish that our markets really grow at double digit. We would like to be optimistic about it.
Okay. Sir, thank you very much and all the very best.
Thank you. Thank you.
Thank you. We would like to remind participants that you may press star 1 to ask a question. The next question is from the line of Dhruvam from HDFC Mutual Fund. Please go ahead.
Yes, sir. Thank you so much for the chance. So first question was on the fatty alcohol. Now you give prices for fatty alcohol in your presentation. As a share of total RM, what would this be of your RM cost?
That's fatty alcohol is close to about 65% of total RM consumption.
65%.
60 to 65.
So, what I was trying to do is I was looking at the total cost of material on a per kg basis, the RM cost on per kg or per ton basis, as you would see. So if I see the cost has been flattish or has declined on a QOQ or a YOY basis, versus the fatty alcohol on a dollar basis that you have reported has increased. So is there something to read, or is the mix changing, or what's happening? How should I align this?
First of all, what we need to understand is that the fatty alcohol prices, what is given in the presentation in terms of what has been the quoted prices, okay, the quoted market prices, okay, now published market prices. Now the fatty alcohol prices started registering a significant jump post middle of November, okay. So if you look at it, the surge started happening, okay, post middle of November. So the average that has been put there is essentially in terms of what the published prices are, and it has been majorly taken up the average by what happened week on week post middle of November. Okay, so for this to be getting reflected in the revenue growth terms, okay, in terms of higher price of fatty alcohol flowing into our this thing, would probably happen more towards this quarter.
Okay, got it. Okay, because even for on a YOY basis or even in the previous quarter there was a decline. So I was just wondering, is there some efficiency change in, some procurement, model change or something else which is also, probably flowing out and helping us?
No, see, what is important is that we ensure that we buy competitively and we ensure that we price competitively. So, the market situation in terms of the way the prices move up and down, our policy in terms of managing the risk on our feedstock is extremely robust. And we ensure that, within that framework, we see as to what best job we can do in terms of maintaining a competitive sourcing of our feedstocks.
Got it. Yeah. And so if, as this, the fatty alcohol starts reflecting in your RM cost in the subsequent quarters, that will also reflect in your realization also. So that way it gets offset, largely.
What do you mean the realization?
In your pricing, in the final product. So basically I'm trying to say the margins will not be influenced because of the change in the RM cost.
Yeah, because it all depends on the competitive dynamics, and yes, logically, okay, increased raw material prices, okay, do get reflected in our realizations in terms of the selling prices.
Got it. And so the second question was, I was trying to split your, consolidated profit between standalone, which I believe is largely India, and the subsidiaries. So the console minus standalone, and I get the subsidiaries number. So there has been an impressive improvement in the subsidiaries margins. So India business the standalone business has also improved in margins, but the subsidiaries are driving a bigger improvement, even excluding the 14 crores of one-off. So, sir, anything that you can highlight? What's driving this? How sustainable this is?
This has, as we have said, there has been a good, robust growth as far as our Egypt operations are concerned. So we have grown pretty well for the 9 months as far as Galaxy Chemicals Egypt is concerned, driven by good growth in local Egypt. We have also grown pretty well on our specialty proteins from our USA operations. So all in all, both the subsidiaries have done pretty well in the first 9 months of this year. Despite a washout in the first quarter. The first quarter was very, very difficult. I think where all of us started with a lot of pessimism. But I would say ending quarter 3, both Galaxy Chemicals Egypt and Trike have grown pretty well.
Okay. Got it. And so the last question was on just to get an industry macro scenario. I'm not very sure about how the dynamics in the industry plays out. If you can help us, is for example after this COVID, has there been any supply disruption from the suppliers of surfactants, the products like you, which have probably gone out of the market and probably is benefiting us and will probably continue to benefit us in future also, given that these players are now probably because of some of the other reason, probably financial stress or something else, they are out of the market.
So, what I like to state is that there's nothing very significant. This something in terms of supplies going on and off in various regions, okay, keeps happening every year, okay, in terms of some stress here or there. So that has not been anything significant. But what has been significant this time has been in terms of the way the global ocean logistics situation has played out. The last about 3 to 4 months have been pretty bad in terms of availability of container space, and the way the freight rates have moved up significantly. Okay, they've all, in some sectors, have gone up by almost 4 to 5 times. Okay, so now these disruptions obviously then lead to the supply balancing itself very differently. But we would expect this particular situation to continue in terms of the global logistics disruption at least till June, as per what reports we read. Okay, so other than that, there has been nothing where we have had very significant rebalancing in terms of the supply situation, barring for these reasons.
Got it. Sure. Thank you so much, sir. That helps. Thanks a lot.
Thank you. The next question is from the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Yeah, thanks for the opportunity, and again, congrats for a good set of numbers. So the first question is, again, taking from the earlier participant on the gross margins. So just on the mathematical calculation basis, if I take that 60% of our raw material price has increased by, say, 10%, and which on a YY basis you have indicated 33% increase in fatty alcohol prices. So if I do the math on a YY basis, our gross contribution or the cost of goods sold has reduced by about 7%. So which effectively means that there has been almost 30% decline in the rest of the 40% of our raw material basket. So is there anything which I'm missing, or why there has been such a stark decline in our cost of goods sold by about 7%? Yeah.
One thing that I'd like to say, Rohit, is that what we use as article prices are the published prices, and their average of the published prices which gets published week on week. Okay, so trying to compare that, because my actual buying doesn't happen on a weekly basis. Okay, so when you try to come to conclusions basis this what we report as published prices, okay, you may not come to the right conclusion. So that is my first communication to you, because what we give is what are the published prices, which is there for everyone to see. But my buying will not be in the line with the published prices.
So then I think this is a distorted number which we are saying, because then we are absolutely looking at...
Rohit, the objective of giving the fatty alcohol prices, because one of the major feedstock is for the community to know as to how the prices are moving. Okay, but how is it that I will be giving my actual buying prices? That can't be expected, correct, Rohit?
No. I'm just saying that because the thing is that then probably... for us, it is very difficult to justify why there has been a decline in cost of goods sold, despite being the our revenues at similar level and raw material prices going up by 33% YOY. So I mean, it's a little bit difficult, even if I put it mathematically, even taking 0% increase in 60% of my raw material. Then also it just says that my other raw material portfolio, 40% of portfolio has declined on a YY basis.
happened in November itself.
Yeah, so first of all, the alcohol prices started going up significantly only post mid-November, as I explained initial part of the call.
Okay.
So it will not reflect in your October, November, December numbers, no? So the whole pipeline is almost of 1.5, 2 months, correct?
Right.
So it only started going up significantly from mid-November onwards.
So this is the exit rate we are talking about, $1588 per ton?
$1588 is the average. So it is like the average of first week of September, average prices quoted second week of September. That way you have 12 numbers that get averaged out. But the major increase, in fact, fatty alcohol prices, okay, in the last 3 months in November, okay, have gone up by almost 50%. Okay, and all has happened in the period from middle of November, okay, till middle of Jan.
Right. Fair enough, sir.
Fatty alcohol prices as of today are upwards of $2,000.
Oh. Fair enough, sir. Understood. So the second question is on the CapEx. So earlier we had indicated that the major CapExes are generally done every after 3 to 4 years, and that's been our history. But in the recent past couple of years, we have been on a capex spree of around 150 crores every year. So has there been any change in terms of our product portfolio which requires a consistent year-on-year capex compared to earlier where we used to do it in a block of 3 to 4 years and then again wait for another next 3 to 4 years to come back to optimum utilization? Thank you.
Everything is in response to market situation, market needs, okay? So our capex will be a combination of brownfield projects, R&D investments, then debottleneckings, minor expansions, and so on. Okay. So every capex that we undertake, as we have already said, we would like to create capex in anticipation of the market needs, and so as and when we read the market, we start responding to it by our own capex proposals.
Right, that explains. But just again, slightly delving into it, in terms of volume growth, in the last couple of years, our volume growth has been about 4%. And this year, for first 9 months also, the volume growth is about 4.5%. So given that the volume growth is relatively tepid, this incremental capex is going in for some specialized products which require dedicated facilities, or is there something else, or probably the new capex is coming at slightly higher cost than what we have been doing in the past?
No. We see, as we have mentioned, we have a big portfolio of products, and we already mentioned that whatever we are setting up in Jagadia was for the specialty care ingredients. Okay, we have already completed the capex of performance surfactants which we mentioned, because we had commissioned those in Jagadia almost 2 years back, and also in Egypt. So when you talk about the growth rate is a consolidated growth rate of performance and specialty ingredients, where performance surfactants in terms of volume dominate in the total. Okay, so the capex that is being undertaken right now are for specialty ingredients, which is going on in Jagadia, one, and number two, the capex, major capex for our innovation new products at Tarapur. These are all for new products R&D. Yeah.
All right. Thanks, sir. So just one last clarification. So is there any plan of inorganic initiatives, maybe to enter into some new products or new category, or we would like to go organic way because our R&D is very strong? Thank you.
Yeah, so as we have been saying, we constantly scan the external environment to be looking at some real good opportunities for acquisition in line with our strategy, and that will continue. So that is something that we keep doing on a continuous basis.
Sure. Thank you so much, and best of luck, sir.
Thank you. We would like to remind participants that you may press star 1 to ask a question. The next question is from the line of Sagarika Mukherjee from Elara Capital. Please go ahead.
Yeah, thanks for giving me the opportunity. So a couple of things. regarding your performance and the specialty surfactants and specialty products that you sell, in the long run, do you expect the specialty care products to kind of become bigger than performance? And why has it been that your pricing growth or the total value growth in performance has been lower than the volume growth, while it has been opposite in specialty? And secondly, in terms of the flexibility that you have in passing on the inflation to your customers or the end user industries, what kind of contracts do you have, and what kind of protection do you have against depreciation of the rupee? Most of your commodities being imported in the country.
Natarjan, so I think the way our business model is structured, it's as to how we are able to pass on the product, the feedstock price increase and decrease, because obviously we need to ensure that we are able to price our molecule competitively, in line with the established market prices. That's as far as the performance surfactants go, and we have a very robust risk management model in place, which ensures that we are able to be competitively sourced in an environment which is pretty volatile. So that has been demonstrated over the last about 3 to 4 years when the feedstock scenario has been extremely volatile. With regard to the specialty care and the performance care portfolio, whether specialty will grow at a higher pace and it will rebalance in favor of specialty products, we explained it earlier as well that we would want to grow both the legs. And as you know, the specialty ingredients are value delivery enhancers in the final formulation. But the major portion of any HPC formulation is all about cleansing, and that obviously is all catered to by performance surfactants. So that obviously the balance is essentially would be in that 65-35, 60-40 range. That's what we expect. But within the specialty care portfolio, our innovation efforts in terms of getting new products into the market will ensure that we keep churning my specialty ingredients portfolio in a way that we are able to come with better and better molecules in line with the consumer trends.
Sure, sir. So can you give us something like average realization that you have in performance and specialty ingredients and the difference between the...
That is something we will give, because it will be essentially be not giving the right indication, because it's a combination of various products and various ingredients and various active levels. So that will not essentially be indicative and it will be misleading. And that's why we don't give it.
Sure, sir. The last question I have is what kind of contracts or arrangements do you have with your end user industry? Like, is it like a very spot contract, or is it very long-term contract, or is it 3-month contract? And what kind of hedging policies do you have against, because most of your ingredients are imported, as I believe, and also dependent on the currency level?
See, with all our customers, we have a long-term understanding, but periodic contracts. We have a very, very long-term relationship with all our customers. As we say, our relationship with customers is anywhere from 10 to 40 years. So we have long-term understanding, and there are always periodic contracts.
See, just to probably expand more on that, so we have contracts, multi-year contracts for certain products. We have contracts that are for 1 year, contracts for 6 months. And then in obviously the multi-year contract, we also have alignment in terms of the price change mechanism, which ensures that we are able to pass on the raw material and the exchange this thing that will be there.
So just a small follow-up. Then how many different competitors are you competing with, let's say in specialty and performance, along with yourself? How many different vendors are there using?
There are multiple competitors globally, and different competitors in different geographies. Yeah. And the major competitors for us across the globe are BASF, Clariant, Stepan, Solvay, and in terms of mild surfactants, we would have companies like Schillen, Schulacher, Trendlyne, and so on.
So, but unlike our very worthy competitors, Galaxy is the only company that is exclusively focused on ingredients for the home and personal care industry. So that's what differentiates us.
Sure, sir. So just want to understand such exceptional situations where your fatty alcohols, I believe, are also derived from palm oil.
Yeah,
palm kernel oil and coconut oil. They are not from palm oil, but palm kernel oil.
Sure. So in this situation, an exceptional situation where we saw a 50% kind of or 50% kind of inflation, and let's say in, I don't know if it will settle down very quickly, but let's say in another 3 to 4 months it settles down and then start getting into deflation, then you will probably have spent a whole year without any pricing changes and probably taking the dent on your margins. Is that a case that you have in case of your arrangements with your customers, or is there a kind of a leeway that you have that you can pass it on to your customers also?
So these are not exceptional situations. As far as raw material prices are concerned, these happen periodically and cyclically. We are quite used to these cyclicality. And here is where Natarajan would talk about the way we source our raw materials.
Yeah, so like what we have to say is that first of all, we need to ensure that we source competitively, given as to how the market situation pans out. So as we have very deep and long relationship with customers spreading over 10 to 40 years, the same we do with our key vendors as well. So first is ensure that we have such deep relationships, and also ensure that we are able to have the right calls taken as to when we should buy, how much we should buy, within the risk management framework that we have in place, and ensure that our objective is always to be in line of the market, not to beat the market, because we're very particular that we don't build unnecessary risk into the buying portfolio, by trying to beat the market. So that's very clear.
All right. So the last question really is, what is the ratio between the specialty and the performance ingredients that you sell? What is the ratio of the market? If you could just highlight that. How big are these relatively?
So, as we said, last year in FY20, the split was 62 to 38. Current year it is 59 to 41. That is in quarter 3, and YTD December is 64 to 36. So we have mentioned that this will hover around 2/3 and 1/3, and this will keep moving up and down
in this band.
Yeah.
But you feel the industry is also in this ratio?
No. The industry it is very specific to us. Okay. We are the only company who are focused on the personal home care industry. The industry will have different percentages as far as their split is concerned.
So the specialty ingredients could be a much smaller market than the 30, 34, 40% that you're highlighting here, compared to performance. Much smaller than.
Can you repeat, please? Can you repeat?
So I just wanted to understand the ratio.
Mukherjee, ma'am, I would request you to rejoin the queue for follow-up questions.
Sure, no problem.
Okay, thank you. The next question is from the line of Abhisar Jain from Monarch. Please go ahead.
Hi sir. Congratulations for a good performance again in Q3. Sir, just wanted to know that at the start of the call you mentioned that the new innovation-based products formed 5% of the volumes in Q3, and you have indicated that this should progressively keep growing. So just wanted a little bit more color on this in two things. One is that whether in 3 to 5 years this 5% percentage can go to a more meaningful number, and if you can give some sense on that. And secondly, sir, that on this volumes, is it safe to assume that we will be making a much higher EBITDA per ton, which can be higher versus our overall average by say more than 15-20%? Just wanted some guidance on this.
Yeah, we do our EBITDA per ton on these new products certainly are higher compared to the average. But you see the percentage of, as I said, these new products will keep on growing. And in our industry, we are fortunate to have long product life cycles. But whether the percentage will keep on growing, because what happens is we define sort of new products as only products which have come in the last, let us say, 3 to 5 years or so. So what is a new product today will become an old product after some time. Okay, so the definitions will keep on changing. What is important to note is that these new products with long product life cycles will continue to grow and make their mark in the industry.
Okay, understood, sir. Understood. And sir, just one clarification and bookkeeping point of view on the export incentives that you have mentioned that there was a 14 crore additional in Q3. So sir, just wanted what is the usual run rate and what was the 9-month number for this? So just to understand for which period did this 14 crore appear?
See, basically what happens is that this is pertaining to Egypt. In Egypt, what we do is that we do the export incentive accounting on receipt basis because the payment timing depends on the allocation of funds by the government. There were some areas to be received, right? And those areas were received during the year, during this particular quarter. Otherwise,
so what is important to note is that what we received is not just belonging to last year. There was also a component of belonging to the previous 2 to 3 years.
Basically, there was an arrears which was accumulated.
Yeah,
right?
so arrears which are accumulated. And since we are uncertain about the period of receipt because it depends upon the government disbursement, we account it only when we receive it.
Okay, understood. So this 14 crore is for
Q3.
More number of but
it doesn't belong. It
doesn't belong to Q3. It belongs to the earlier periods.
Right. And so just one last question. So since the RM inflation now combining Q3 and in this quarter Q4, since you mentioned that it's gone above $2,000, it's very, very steep. So definitely in terms of the ability to pass through, it will be constrained somewhere, right?
No,
to the full extent, I'm saying.
I don't think so. It is not the first time that we have went on the.
Yeah, this is something that we are used to. Periodically, and this is where the Galaxy's risk management comes to our aid.
Yeah, I understand, sir. Just asking from the point that any which way we are sitting on almost one of the highest gross margins level in the last 2 quarters, right? Which has improved our EBITDA per ton. So from that angle, I was thinking at least some kind of normalization may be on the cards. I get your point, sir. Yeah, that's right. Okay, sir. I think that's from my side, and thank you so much, and best of luck.
Thank you.
Thank you. We would like to remind participants that you may press star 1 to ask a question. The next question is from the line of Manoj Baiti from Carnelian Capital. Please go ahead.
Hi, sir. Thanks for taking my question. My first question is, as you mentioned that there has been a steep increase in our raw material price, which is fatty alcohol. Just wanted to understand that because of this steep increase in price which has happened mid of November, is our current quarter earnings also include some inventory gains because the raw material which we were already holding was a lower price raw material. So once this inventory gain goes off, whether we can expect some correction or some normalization of margins going forward?
No, it is. I don't think right to conclude that way. So
there will always be some inventory gains.
Mm-hmm.
Okay. Always, all some inventory losses which can happen. There will always be. Okay, because you have to run business keeping some inventory.
Right.
Okay.
Right.
But then that is not the basis of performance.
Mm-hmm.
Yeah.
Mm-hmm. But sir, like if we see in terms of accounting, like once we do like FIFO kind of accounting for inventory, won't it be correct that like one of the quarter because of the accounting implications can have like these kind of inventory gains? I understand over a long period of time it gets normalized, but particularly of this quarter when we have seen such a steep increase.
What happens is that when you run an ALM model, there is going to be a cap on the inventories that you carry, right?
Okay.
So the risk is managed that way, and to that extent, the impact is all restricted. It's not that the inventories are risk levels are not capped, right? Okay. So there is, to that extent, there is moderation in the the accounting or the other aspects don't create such aberrations.
Okay, got it, sir. And sir, secondly, I missed that point in terms of margins. You have upped the guidance. So, sir, what is our current sustainable margin guidance?
No, we have mentioned 15 to 17,000 per metric ton.
Okay, 16 to 17.
Earlier, now we have raised it to 16 to 18 now.
Now it is 16 to 18. Okay, sir.
And that's also after observing for 3 quarters, 3 to 4 quarters that sustain, we are above 16,000 on a sustainable manner.
Right, sir. Okay, sir. Thanks a lot. Thanks for taking my question.
Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Onatan Shekhar from Galaxy Surfactants Limited for closing comments.
Thank you, ladies and gentlemen. Thank you for your vigorous and spirited participation. Looking forward to see you again 3 months. Thank you. Thank you one and all.
Thank you. Have a good day.
Thank you. On behalf of Galaxy Surfactants.